Hey everybody, in this video I'll cover options premium, or what we call pricing, and how extrinsic value affect the pricing. Hey, this is Lily and I'm a retiree trader, and I provide options training, especially to retirees who fear that they will outlive their savings, by helping them to become financially independent so that they do not need to depend on their children. In my last video, I covered what we call the intrinsic value. And this video, I'll cover extrinsic value. And extrinsic value comprises of time value as well as volatility. In time value, it decreases when it approaches expiry, just like a bar of chocolate or a packet of milk. When it approaches expiry, usually supermarket will try to get rid of it at a big discount. The moment it expires, the value is gone, and even if you want to give it to somebody free, nobody will want it. So in option trading, let's say if you use time value to your advantage, you can actually make a lot of money. However, if you're a buyer and if you ignore it, or let's say you forgot to exercise your buy contract, or you forgot to close the position, the premium that you paid up front will totally disappear by expiry date. Let's use Apple as an example. Strike price 125. And for this expiry date, July 2021, with 33 days to go, you realize the extrinsic value is 209. However, when the expiry date is further out, let's say November 21, number of days to expiry is 159, the extrinsic value is higher at 754. And if you look even further out to June 2022, the expiry date for the same strike price is 1291. So you can see that the further out a option contract is from the expiry, the more valuable the extrinsic value is, because it's more expensive. But the nearer it is to the expiry date, just like a packet of milk, the value would really drop. So let's use this table. With 642 days to expiry, the extrinsic value is 2030. 369 days to expiry, extrinsic value for Apple is 1530. The difference between the two is $5, although the date difference is 273 days. And if it's 159 days to expiry, the extrinsic value is 990. The difference between the two is 540, although we can see that the days difference is 210 days compared to the earlier 273 days. Yeah, but the difference is higher. And if it's 33 days to expiry, the extrinsic value is 445. The difference is 545, although the difference between 159 and 33 days is 126 days. It's lower compared to here, but the difference is higher. And if it's 0 days to expiry, basically the extrinsic value is 0 because it has lost its value. So again, Apple, extrinsic value for call and put. Basically, if you look at strike price 125, it remains not much of a change. Like 46 is basically quite the same. Yep. And you look further out, 125. The extrinsic value is around 1474. So basically, whether it's the put or the call, the extrinsic value for the same strike price is not much of a difference. So how does this apply to option trader? If you're an option buyer, you want to buy more time. With more time, it allows the option price to be stable. As you can see, over here, it is pretty straight. It doesn't fluctuate that much. It doesn't drop that much. But once it reaches here, when there's less time, the value drops. So time decay for a buyer with a longer date to expiry is more manageable. But if you're a seller, you want the date to expiry to be shorter, because with shorter date to expiry, there's faster time decay for the buyer, and therefore it is to your advantage. And with this, you have less obligation as well, because it will not work against you with lesser time decay. Another factor that affects extrinsic value is volatility. Let's say if you want a enter a buy call position with date to expiry 20 Jan 2023, 584 days to expiry, strike price 115 for Apple and Taiwan Semicon. Apple price is 129.64 and Taiwan Semicon is 119.45 the stock current price. Which do you think is a higher extrinsic value for these two? I think naturally we'll think it's Apple, correct? Let's look at it. Apple, the current market price is 129, and for TSM, the current market price is 119. So we look at the strike price 115 for Apple as well as for TSM 115. Let's look at the extrinsic value for Apple. It's 1192, and for TSM is 1507. It means to say that we are paying more extrinsic value for TSM. Why? Even though the stock is lower than Apple, why are we paying more? It's because of what we call the volatility. Here it is, implied volatility for Apple is 24.96 versus 32.11 for TSM. This is the implied volatility of the stock. Therefore, with a higher volatility, let's say, for example, let's say you are selling insurance to someone who is a smoker, and naturally you want to charge more premium because you are taking more risk with the person. So this is the same as stock option as well. If the stock is more volatile, where it fluctuates high and low, you want to be paid a higher premium as a seller. So I hope I've given you value in this video, and I hope you can like and subscribe to my channel, and I'll see you in the next video. Bye.